Marie.
La rôle évidemment français en anglais.
Anglais.
Each team has 20 minutes to present its case to the judge. I will hold up a sign for the last 10, 5, 2, as well for the last 30 seconds of the presentation. During the last 10 seconds, I will indicate with my finger the number of the seconds remaining. If you have not finished your presentation after 20 minutes, you will be stopped in order to proceed with the question and answer period. A question and answer period of a maximum of 5 minutes is allocated to the jury at the end of your presentation. Please note that at any time you cannot say or reference the name or the location of your university. I will now let the judges introduce themselves. You can start your presentation when they are finished.
Hello, my name is François Schwab. I'm working with the Jardin Financial Security head office in finance, namely to support SFL level.
My name is Martin Poirier, manager in the SFL Financial Center.
Mario Lavallée, professor of finance, Sherbrooke University.
All right, well, good afternoon, everyone. We are here, we are a consulting group hired by Mr. Bonconseil to advise Mr. Lajeunesse in his future strategic outlook for SFL Holzschlager. So today we're going to talk about a few things. We're going to go into the current situation, so what is SFL Holzschlager facing today? And then we're going to go into more of a step back and look at the industry overview and take more of a macro outlook on this industry. And then once we do that, we'll figure out what is important for us to make a decision in this, either an acquisition or an internal growth project. And once we figure this out, we will look at the acquisition considerations. So one of the projects we're looking at today is an acquisition of a separate financial services company. So in order to figure out if this is a good acquisition, we have to look at our criteria. And then finally, what is the valuation at which we'd be willing to bid for this project, and how would we finance this project? After this, we'll look at the transaction. So how are we going to actually be able to transact this acquisition? And finally, what are the risk and mitigations of this process? So first and foremost, it's been 5 years since Mr. Lajeunesse has acquired SFL Holzschlager, and some service initiatives in this branch have generated lots of revenue growth in the past 5 years, except last year, the revenue has been more modest. And Mr. Lajeunesse is actually worried that the future outlook of this branch is more dim, and that there is a more of a downside cycle going forward. So in order to achieve the main objective of long-term growth, there are kind of two options we are facing today. One is an internal hiring project. So one of the main ways for this branch to grow is to actually hire more representatives. And this project would instill a new full-time recruitment director and actually change the whole process of hiring. The second is actually an acquisition of, like I said, another financial services company, Capital, which has 12 employees currently working for the company. So to summarize, without intervention, downward industry cycle could lead to an accelerated revenue slowdown. So now let's take a step back and look at the industry. So the size and resilience of Quebec's financial services industry has been quite strong, and more importantly, the insurance sector of this industry has been quite large, especially in per capita spending for insurance in Quebec. Now, for insurance, there's kind of three models in which people can buy insurance. Number one would be the banque assurance, where people buy insurance at a bank. Number two is exclusive insurance, where the representatives actually deal with one manufacturer of insurance, and they get a lot of benefits from this manufacturer, such as funding and kind of help with the processes. And number three is a non-exclusive insurance, which has a big trend now because of the whole industry landscape. It's becoming much more harder for representatives to deal directly with one manufacturer. So non-exclusive insurance is kind of like a brokerage where they deal with a lot of manufacturers. And overall, the significant consolidation of these segments has forced smaller players to come together. And this is important, as you'll see later on with the acquisition potential. So SFL Holzschlager, the main company we're dealing with today, operates in a hybrid model where it has the benefits of an exclusive model, but also deals with many manufacturers of insurance. So it kind of gets the best of both worlds. So like I said, they have an excellent employee retention of 95%, which is good. So the employees that they hire stay at the company. But the main problem, as Mr. Lejeunesse has said, is actually getting the number of hires to increase. So hiring can be separated into like 3 different segments. So the number of people you hire, people that are staying in the company, the retention rate, which is already very good. And number 3 is the productivity of the employees that you actually have in the office. So today our main concern is dealing with the number of hires, or the size of the company that we're dealing with. So this is important to consider. Another important consideration is the financing. So Mr. Lejeunesse, who bought the center in 2009 for $4 million, bought it with an $800,000 down payment, a $2.8 million loan, and $400,000 is still outstanding. So there is some constraints with financing still from the prior acquisition. So the company is actually, like I said, very strong. It was named Canada's Financial Center of the Year in 2012 and 2013, the center specifically. However, 2014, Mr. Lejeunesse is not too optimistic about the outlook due to the structural slowdown of the center. So it's a strong company, but it's in need of a shift to overcome this downward cycle. So what will be this shift? So we recommend the acquisition of Clef d'Or at a price of $1.8 to $2 million, and which is a price lower than the intrinsic value that we've valued through our valuation model of $2.5 million to $2.9 million in order to foster growth initiatives. So I'll pass it on to Anna, who will talk about why we chose this acquisition.
Thank you, Henry. So in order for us to properly assess which of these 2 alternatives is best for us to approach, we've come up with 3 primary decision criteria for this event. So the first criteria we want to look at is imperative to the business, and that is long-term growth. It is what Mr. Lejeunesse wants, and it is the #1 priority that both alternatives will provide us. The second we want to look at is the speed. So in the past, Lejeunesse, this whole company was acquired in order to foster the speed of growth, and we believe that it is important to consider that in this acquisition going forward, because by acquiring 12 representatives, it will be much faster than hiring 12 representatives, and these new 12 representatives will bring in their client's account, which we will have to build for the new recruits, and thus the speed would also lead to favorable and more profitable projections. For the recruitment side, we will show you some of the potential reasons why it is negative on profitability, and further indicate why we have decided to choose the acquisition as the main alternative for which we can help your business grow. So here are some main acquisition considerations that we want to look at. The first is the alignment of the product and service offerings. We believe that SFL has a lot of these synergies, potentials with Clef d'Or on the product side. Furthermore, there are also some cost synergies we can explore. Currently, the rent is at $90,000 annually, and the lease is for next 6 years remaining. But after that lease has ended, we can then combine the divisions in one office space and save more money than those in our projections currently. The third and most primary reason we believe this is a good acquisition opportunity is Clef d'Or's eagerness to sell. First of all, its leader, Mr. Lafortune, is retiring, and for him, he's seeking to sell this business in order to cash out on this early retirement opportunity, because he has not generated enough money from his current revenues and so forth in order to foster that retirement needs. The second important reason why they would be willing to sell is the compliance requirements. Ever since 2000s, there have been regulatory actions which prevents the manufacturers from selling directly to the advisors. And due to this, Clef d'Or has lost one of its big direct contacts with the manufacturers, and by combining this company with ours, which is a hybrid model, they can thus reduce the large money they'll be paying for the general agents, and this will increase profitability and is a great incentive for why they should be acquired. And also, due to this eagerness, they can be acquired at a very attractive price. We believe that the owner of Clef d'Or, Mr. Lejeunesse, has indicated he would like to sell at $1.8 million, which you will see is very much below our valuation what their business can bring us. So now I'll pass it to my colleague Henri, my colleague Tom, who will further introduce to you the valuation.
Thanks, Anna. So I'm going to go into quite a bit of depth on the actual numbers behind this valuation and why we think that the acquisition makes sense. So first off, looking at how we set up the revenue and operating expense assumptions for Clef d'Or. Those growth assumptions you'll see are constant throughout our model. And those are based on the average of historical growth. We have historicals going back to 2009, I believe, on Clef d'Or. And so that's the average of annual revenue and operating expense growth from 2009 to 2013. So as you can see, this gives us a fairly steady EBITDA that starts off around $500,000 and grows at roughly 2% per year. So this isn't explosive growth, but we do think that it's strong and steady. Second off, looking at depreciation. Again, this is based off of the historical growth of depreciation. We would have liked to have some more insight into the assets that the company held and how they were being depreciated, but unfortunately we had to go based on this historical assumption. So this brings us into an EBIT, which is starting off slightly under 500 in 2014, and then is growing over the course of the model. We saw that the tax rate was nearly constant at 19%, so we have no reason to believe that will change. So in our projections, we're using a rate of 19%. And then this is going to give us a net operating profit after tax that starts at about $400,000 and grows to $450,000 by 2019. We're assuming that capital expenditures match depreciation. Again, we would have had to like more insight into these assets, how they're being repurchased, but based on the information we have, we thought that this was the most defensible assumption. And we're assuming that net working capital is staying the same because there's no real need to hold additional inventory or other components of capital at a financial services firm. So this is giving us a free cash flow to the firm, which is equal to the net operating profit after tax. Again, starting at about 400, rising to 450 by the end of the projection period. And then we're discounting this using a cost of capital of 18%, which we'll run through how that was, how we arrived at that number on the next slide, and a terminal growth rate of 1.5%. So this is giving us an enterprise value of about $2.5 million, which implies a current multiple of about 5.06. We also calculated an implied exit multiple based on our growth assumptions. We found that implied exit multiple was still around 5, so we think the fact that stays flat indicates that our growth assumptions were sound. Looking at some sensitivities here, we sensitized our enterprise value to cost of capital around that 18% number, and then growth from 1 to 2% with the cost of capital being 17 to 19. And this is giving us, as you see, a fairly tight range from 2.4 to 2.75 million. So again, we see that this is not a particularly sensitive valuation. And again, looking at the implied exit multiple, using the same sensitivities, we see that we come to a valuation, an implied exit multiple of 4.5 to 5.5. And again, we think that given that we see the multiple right now being around 5.1, we think that that's very reasonable. So stepping into our cost of capital build, we first off looking at how we built our cost of equity. So we assumed the unlevered beta was around 1. We didn't have specific information on this, but because a financial services firm is going to be so quite closely correlated with the market, we thought that an unlevered beta of roughly 1 was reasonable. Our target debt to enterprise value was based on the current debt EV at SFL Hochelaga, which is roughly 40%. We know that the purchase price 4 years ago was $4 million, and that he currently holds $1.5 million in debt on that, so that gives us about 40%. We're still using that same tax rate of 19%. And that gives us a levered beta, which is centered at 1.5, and then we've sensitized out to be able to do about 1.35 to 1.7. You'll also notice that we've added a quite considerable size premium. We think that since this is such a small acquisition at around $2 million, we thought that it was important to be very conservative in our assumptions and to add that 15% size premium so that we could, so that we wouldn't undershoot the cost of capital on this company. So that gives us a cost of equity of roughly 25 to 28%. We know that Mr. Lajeunesse can borrow at 5.8% from Desjardins. So given our risk-free rate of 3%, that implies that he has a credit risk premium of about 2.8%. And then looking how we came to our WACC, We took the cost of equity and cost of debt numbers, took our target debt enterprise value and our tax rate, and that gave us a WACC of roughly 18%. Looking how we're going to finance this project, we think La Jeunesse should finance this project with debt from Desjardins at 5.8%. So this is implying interest expense of $104,000 to $116,000, assuming $1.8 to $2 million in debt, which is easily covered by Clef d'Or's EBITDA, which, as you'll remember, was above 500. Now we're going to pass it on to Anna, who's going to talk a little bit about the internal growth strategy.
All right, so we want to also evaluate the other alternative in depth to further assure you that you've made the right decision with the acquisition. So what the internal growth strategy is trying to do is essentially want to hire a HR director to raise the recruitment level to 18 people per year hired, which is actually currently 9 people above what we are currently going to hire in the new year. So the reason why we want an HR director is because right now we're lacking such a position in the role, and we believe by installing this person, the company can indeed hire more people going forward who are just as productive and will help grow the firm in a sustainable way. However, the main risk and challenge we find with this alternative is that there's no new clients being brought in by these recruits. Essentially, there's 2 types of recruits. There's either those without any experience or those who have experience, but there's no indication they'll bring in clients. And if we add in 18 or even more per year going forward, we risk the potential to cannibalize our existing clients. And thus, this will not entirely help the firm grow in a sustainable way on the profitability side. The 3 parameters that we mentioned earlier for growth in this scenario is the number of hires, retention of hires, and the productivity quality of the hires. So in FSL, that is being measured, the productivity, as in sort of a revenue per advisor. And that, in their terms, is called PC. And in the next slide, we'll show you what we believe the projected PC per person would be and come up with a valuation of this strategy and why this strategy is lower than that of the acquisition. I'll now pass it on to Tom for further indication of the valuation.
So we based this, our estimation of the incremental revenue from the new hires on this measure of the PC. So looking at the expected PC from the different levels of productivity and what percentage of new hires fall into those productivity categories, we think that the expected PC from each new hire is roughly $16,000. So then we took that expected value and we projected the incremental revenue from each of the new hires. So we know that right now they're hiring 9 new advisors per year, and we know that they expect the hiring of the director to get them back to the 2011 levels of 18. So we're assuming that there's our 9 new recruits in each year here. Looking at productivity, we saw that in most advisors' first year, they are running at about 60% of that expected PC. Then in their second year, they're running at about 75%, and by the time they've been there for 3 years, they're running at 100% productivity. So based on those assumptions, we calculated this incremental revenue from new hires, which you can see is $85,000 in the first year, and then is rising rapidly as the hires who were hired in 2015 become more productive going forward, and as they make further advisor hires. We based our FCF projections based on SFL's historical free cash flow margins, which we can see average out to 9.3%. And then this is giving us a free cash flow starting at about $8,000 and then going forward up to $58,000 by 2019. Using the same discount rates and terminal growth assumptions that we had for Clef d'Or, we can see that this is giving a value of the project at $238,345. Now, given that we expect there to be some additional cost based around the hiring of the HR director, we think that this enterprise value is quite low, especially when we consider that with Clef d'Or, we can acquire a company worth $2.3 to $2.7 million for only $1.8 million. Now we're going to pass it on to Ari, who's going to talk about to Anna, who's going to talk about the transaction process.
So in any sort of M&A process, we would like to recommend that you currently have still 5 phases left to complete before this transaction can close. You're currently in the approach to target stage, which by you have signed a confidentiality agreement with Clef d'Or in order to gain information about their access. And now we propose that you submit an initial bid and then follow that up with due diligence, which we would like you to focus primarily on looking at getting access to Clefdoor's data room, going through integration processes, and also exploring the financing options. By final bid, we would have completed your financing, and we would like you to, still negotiate on the price as well as the term of transaction during executive agreement, and then finally close the transaction by holding a PR release and, finally finalizing all the terms that are necessary. So next, moving on, is a couple risks and mitigation terms we want to consider. So 3 potential risks is, well, with this acquisition, there might be decreasing employee morale and productivity. And the number one way we can really try to mitigate against this risk is by negotiating work contracts so that these new employees that we just acquired through Clefdoor will stay and be productive members for the next couple of years. As you can see, all of the other risks we consider also have good mitigation strategies. And now, we'll take you through our final 3 key takeaways. We recommend the acquisition of Clefdoor at a price of $1.8 million to $2 million, which is less than intrinsic value you see here. This acquisition will enable faster growth and increasing revenues by 9%. And the present value of the internal projects is only $234,000, which is way less, and thus we recommend the acquisition of Clefdoor. Thank you so much for your attention, and we hope you enjoy our presentation.
Have you looked at possible synergies from merging the 2 operations? We know that we had the rent is there for a while, but is there the...
So we looked at that and we thought about potentially cutting overhead costs, cutting overhead from Clefdoor. Unfortunately, we looked through the breakdown of their overhead, and the only thing that could be cut within the 6-year period until the lease expires were their bank fees, which come up to about $1,000 a year. So we think that within our 6-year period, there aren't significant synergies to be found, at least from cutting overhead, although there may be certain revenue synergies. On the other hand, we think that once you get past that period, there's substantial ability to make savings on overhead.
Okay, this situation is based on the fact that we're not growing as fast as we would like to grow. In the case, we presented 2 strategies to grow with. One was the hiring of new recruits and forming them and hoping that they'll produce enough. The other one was acquisition of an existing firm that is in the same business as ours. While reading this case, have you see something else we could do? A third option? Is there something we should think of besides one or the other?
Well, certainly there's the possibility to sort of expand SFL Hochschulaga's geographic reach somewhat. So we think potentially hiring advisors who have client bases in outlying areas could be a way to reach further clients. And also within the context of the case, within the 2 options, we think that there's also further growth potential by bringing the 2 firms together because of potential revenue synergies there, and the ability to bring those 2 client bases together and cross-sell.
I think another option would be, well, it's kind of a tangent off the hiring decision, is more specialization. And when I say that is, like, the biggest factor in hiring is, number 1 is the number of hires, but if we increase the productivity in our model, we can see that the revenue growth from these hires increases substantially. So if you focus a specialization of the hiring to specific subsectors, like the ones that have the most growth, so the breakdown of the revenue for SFL showed that both like asset savings and life insurance had like a higher revenue growth. So if by focusing like an HR director on just hiring for these specific segments, it could lead to more specialization and larger growth instead of just have a blanket hiring decision that covers everything.
Thank you.